welcome to Options Discovery on John Lothian News' The Spread. My name is Esma Awas, and I'll be your host throughout the series. Just like you, I'm no expert, but with the help of some, we can learn more about options together. In this episode, we'll be going over market makers in the options industry. Later in the episode, I get a chance to sit down with Eric Cott, former advisor in education at the OIC and current president of Cott Consulting, to dive deeper into these subjects. Let's start this episode out by going over what a market maker is. For those who don't know, market makers are high-volume traders that always stand ready to buy or sell securities in the market. Market makers make a profit on the bid-ask spread of a trade. A market maker serves as a middleman offering to purchase securities at the bid price and sell securities at the ask price. The difference, or spread, is where a market maker makes a profit. Let's run through a quick example to show how a market maker would facilitate a trade. For example, there's an options contract with a bid price of $3 and an ask price of $3.01. A market maker would buy at $3 and sell at $3.01, making a profit of $1 per contract. The spread on a trade can vary, with profits being as small as a few cents per trade. These small profits can add up since market makers participate in high-volume trading. One of the main benefits of market makers is that they provide liquidity in the options market. Market makers continuously provide bid and ask quotes for options contracts throughout the day. This allows investors to participate in speedy trades. The bid and ask spread of trades can tell you a lot about the overall liquidity of the market. Wide spreads generally indicate less liquid markets due to low supply and demand. On the other hand, narrow spreads trade fast due to high supply and demand. This would indicate that the market is very liquid. The role of market makers in the options market is far from risk-free. Market makers face the risk of time decay if the option becomes more and more illiquid in the position they are holding. This might force them to hold a position until expiry if they cannot close out on a reasonable price. We will talk more about the risk posed to market makers later in the episode. This week, we're lucky to have Eric Cott, former advisor in education at the OIC, to give more insight on market makers in the options industry. Eric has a wealth of experience in the options industry, so without further ado, please enjoy this week's interview with Eric Cott. All right, everyone, welcome to another episode of Options Discovery. Today, I'm sitting down with Eric Cott, the president of Cott Consulting. Eric, can you give us an overview of your background and how you got to where you are today?
Sure. First off, it's a pleasure to be here, Esma. I want to thank Dr. John, as I used to refer to him. He's a real great mentor of mine. John and the Lothian team, it's been an incredible success that they've had. I came a circuitous way to the derivative space. I was actually on my way to law school before my daughter was born, and I worked at a very, very large corporate law firm, Simpson Thacher in New York City. I actually had a slight stint in the public sector. I worked in the district attorney in New York. My 15 minutes of fame was making copies for John Jr., John Kennedy Jr. He was in frauds. I was in rackets. I guess I fought the urge on my way to go to law school. I fought the urge to get into finance because I have three great mentors. That's my father, Barry, my older brother, Noel, and my middle brother, Andrew, all municipal guys. But they sort of convinced me. I went into the institutional business. I was a bond salesman. I spent some time on the buy side. I worked at Merrill Lynch. I was a manager at Merrill Lynch. I managed clients. I managed an office. And that sort of gave me a taste for the option world. I kind of moved a little bit of my business from managed money into the annuity business. And for those who aren't aware, some of the largest users of derivatives or options are insurance companies because they tend to sell products, variable annuities, fixed annuities, where they need to hedge sort of these products where they have living benefits and they want to sort of sell short-term vol and buy long-term. Well, the financial crisis of 2008, I don't know if you were even around, I'm kidding, actually, during that time, but it's still eminent in everybody's mind. Things had changed, and I was with an insurance company, again, an annuity company at that time, and I was introduced to the Option Clearing Corporation, an incredible organization that just celebrated their 50th anniversary in Chicago. First, listed options traded again back in 1973, and here we are today. So I was brought on to what had really kind of been an offshoot of the CBOE and was an offshoot of the ISE. They had internal education mainly to retail, mainly to institution, but not to advisors. That was sort of the holy grail. How do we get to the advisor community? Interestingly, because we're going to talk about market makers in a bit, but interestingly, the first line of defense, those that actually make investment decisions on behalf of their clients, are the ones that were sort of infrequently using options. I had done covered calls and some collar strategies when I was an advisor, but not really. So I came on board in 2009. I'll kind of abbreviate the story. The things that I'm actually most proud of, and maybe I'll share that at the end, but just a couple of highlights were that we actually introduced the first of its kind research, which was a qualitative research study on the DNA, the option usage of advisors, why they do it, why they don't do it, what type of strategies. John was one of the early adopters in 2011 of highlighting this research. I want to give a shout out to Steve Sears. He also was one of those great individuals and others in the industry, of course. And then two other things. We actually launched an option course through the former IMCA, now called IWA, still around, first of its kind, really that kind of highlighted how advisors can sort of take a deep dive into learning about options. And then lastly, which I'm also very proud of, was pre-COVID, I jumped into the deep end of the pool. This was on the kind of encouragement of the NASDAQ exchange, and launched a podcast called Coffee with Cott, which happened for about a year and a half. And then I had a couple of stints here in with Interactive Brokers and some other firms, and actually my consulting firm is what I've been doing ever since.
And speaking of your consulting firm, I know you recently started that in 2022, I believe. So how did your previous career experiences, help you start your own company, and what challenges did you face along the way?
An excellent question. And I fought against doing this for quite some time, really kind of during COVID and then after, when my girlfriend Sheila, my daughter Talia, and I'm sort of giving shout outs to really encouragement. One thing I would suggest to people is those around you, that, your spouse, your family, your children, colleagues. One of my colleagues, Alan Grigoletto, who is sort of an icon in the derivative space, kept saying to me, "Look, I've done it, and you have the wherewithal, the tools necessary." So the premise, Esma, behind doing this was I wanted to build a bridge, a conduit between the buy side advisory, family office, registered investment advisors, the folks that were going to look at the investments, then kind of bridge that gap between the exchanges, the asset managers, the market making community, all those on the sell side, and put those two together and be kind of a voice. And so the business was launched last year, and it's been exciting, a bit challenging, as anybody who starts their own business. You have to be, you kind of have to be courageous. You have to kind of roll. Again, this is probably an analogy with market makers, where you have to see where there's an edge, and you also have to be aware of what the risks are. And we'll kind of we'll talk about that a little bit, but that's kind of the premise was really to bridge the gap between the buy side and the sell side, mainly due to the fact that advisors and even folks that are institutional managers have deviated away from managing risk or mitigating risk, and don't always think about options as a natural progression of when they manage assets. And I think there's a lot of misconceptions. There's a lot of things that aren't kind of people aren't always they're a little bit reticent because of the intimidation.
Thank you for giving a little bit more insight on how you started your own company, and then also some of your background in the derivative space. Now I want to kind of pivot our conversation to the main topic of this week, which is market makers in the options industry. So, for those who don't know, can you give an overview of what a market maker is and what their role is in the options market?
Sure. And I'd preface it by saying I was never a trader. I was never a specialist. I was never a runner. I might have played one on TV. No, I'm kidding. I've been around it long enough where, again, being very blessed to be in the industry for a long time. One of the things that I would probably highlight for your listening audience is the market making community has changed a lot. What I'll do is kind of present first an analogy. I just bike rode this morning very early because it's hot here in Florida. So you have to hedge your bets by getting out there before it gets to 115 degrees. But let's use an example, Esma. If you and I are on either side, I'm looking to sell my bicycle, you're looking to buy one. So you sort of have an idea in your mind, you're looking to pay $1,000. Well, I'm looking to sell that bike at 1,500. If we don't really come together price wise and are able to meet that it again, they're kind of it's a futile effort of the purchase of the bike or the sell of the bike. If we bring a third party in, a bike store like the market maker, they then are able to look at the marketplace, and they're going to be the buyer when there's no buyers around. They'll be the seller when there aren't sellers around. And what they're trying to do is, in essence, they're neither the they're either the hero or the villain of the marketplace, but they're looking to be an intermediary to be able to say buy the bike from Eric, where they can actually buy it at a price that's fair and reasonable, keeping the market sort of healthy that way, and then trying to price it to you, the buyer, at a price that's attractive enough to you. So again, that an analogy of thinking about the bike store, they're sort of the intermediary. And when we talk about market makers, I would encourage those who listen who are retail or advisory and such that they play an important role in the options business. Mainly, they're there to keep the markets efficient. They're there to keep liquidity. And I'm referencing a time period right about the time that I started in '09, but in '08 there were roughly 2,000 market makers. There were about 100 in Canada. Currently, right now, that's less than 50. I mean, it's really, contracted dramatically. A lot of that has to do in the market making community is, I know we're going to talk about technology, and that's one of the areas that's kind of taken the market making community and shrunk it because it's really expensive with all this algorithmic technology and high frequency trading, which we'll talk about. But mainly, again, if I were to compare what's happened in the market making community, what you've seen is sort of similar to what Warren Buffett's done in the insurance business. You have this what was a sort of fragmented business with mom and pop shops, and now you really have these major companies. I mean, all of us that watch TV, we see the Warren Buffett, Geico, Gecko, we see Progressive and stuff, but sort of bringing it back to the options business, it's these are professionals that are there to sort of make sure that things are functioning smoothly, and they really perform a very good function. Again, because what they're doing is they're efficiently kind of keeping the marketplace at a level playing field where it's become that much more kind of seamless for those of us that are new to investing in the option arena, because it was quite different back in the days. I'll reference, and I do this a lot because I'll share with you. I bring up names because these are the folks that really were so good to me as I came in. Shelley Nattenberg is an icon also in the industry, and Shelley talks about the days when he used to work on the floor. And for those who didn't experience being on the floor, they kind of had to make up these spreads, which is the bid, and the ask. The bid where basically you're gonna end up selling, and the ask you're ended up buying. But back in those days, they sort of used a term called scalping. They kind of, I think they improvised because you didn't have the efficiencies in the marketplace. So that's kind of what took place. But I talk about the idea that this idea of efficiency, but it's also transparency. It's another theme that I like to kind of reference because the the transparency is that we're all able to see the bid and asks on the screen. Um, a lot of the liquidity is there. I would say that, you know, the difference between also market makers and brokers is, the brokers operate sort of as the retail component, and the market makers are wholesaling because the brokers are the ones who have sort of direct contact with the clients. They might be providing, research and stuff, but they're in sort of direct contact with the market maker, again, who is really the middleman, and kind of is enabling these transactions to take place.
So I really like that bike analogy you used. I think it kind of breaks it down on a very simple level. And I like how you talk about the market maker being kind of the middleman. So how do market makers manage the bid-ask spread of the option contract to kind of gain profit?
So, it's a little bit different in the stock market versus the options market. And for a market maker, there are kind of a couple of determinants when they look at it. They're gonna take a look at the volume that's out there. They're gonna look at what we refer to as open interest, which is again, how many contracts are out there, what's outstanding, the current bid and ask, because there's not just one market maker. There's, typically multiple market makers that handle multiple securities, that handle, in the option business, multiple types of option underlyings, equity, ETFs, index, and such. There's a lot of moving parts. And it's a pretty stressful job. Again, I'm not a market maker, but I can only imagine the anxiety because, the market maker's looking like any of us, and referencing back to the bike example, it's supply and demand. Might be a lot of bike stores out there, and you might be able to, choose, pick and choose. And so that the pricing, when we talk about the bid and ask, I mean, market makers are not out there to make, you know, incredible amounts of money because, again, they have to take on the risk. So they also need to attract folks that are looking to either buy or sell. Thus, the reason why they sometimes have used the term, back in the day when I was talking about Scout, but they used to say you could drive a truck through the bid and offer spread or the bid and ask spread because spreads were so wide. And again, the community at the time knew how to kind of, uh, let me not use the word manipulate. That's not the right word, but they knew how to sort of play the market a little bit that gave them a distinct advantage. That doesn't happen as much anymore, again, because we don't have as many market makers. And um, the other component I'd add to that, as they start to figure out how to sort of price these things, there are other components that come into play. Obviously, where the markets are in terms of the sentiment, where, again, potentially even where rates are, what's going on in the in the economy. I mean, all this comes in, but I go back to that one theme that's the most important is liquidity. And that's really what plays into this. Again, the market maker has to understand what their risk is because they're taking that on, but they also want to be competitive and post bid and asks that are going to bring in folks who want to be able to trade, and that the execution can benefit them. They also, we could go back to the COVID times of 2020 to 2021, 22. You can go back to the financial crisis of '08. You can go back even to 1987 in October. Those are outliers, but those are conditions that can really disrupt the market maker and how they actually have to adjust things.
I hope you learned a little bit more about market makers in the options industry. I want to say a special thank you to Eric Cott for taking the time to talk with us. Thanks for watching, and I'll see you all in the next video. If you're hungry for more options content, make sure to subscribe to the JLN YouTube channel and check out our social media accounts. Be sure to check out our website, johnlothiannews.com, Markets Wiki, and the John Lothian newsletter for more content.